Okay, well, I think we should get started. I'm reading 3:01 p.m. on the clock on my computer. So I'm going to welcome everyone. Welcome, regular Thursday afternoon Innovative Business Advisors webinar participants. And those of you who are on and hearing our little pre-webinar chat, I'm glad to be back. I was not here last week, and Terry's kind of giving me some of the technical rundown of what happened. But I'm glad to be back, and I'm excited about the webinar today. We have a really great guest joining us for the panel. But let me start first by talking about the logistics, now that we're talking about technology, and that is we're in the Zoom panel, we're in the Zoom portal for this webinar. So take a look at your screen. If you're new to our Thursday webinars, you will see that within the Zoom portfolio or Zoom portal, you have a few indicators at the bottom of your screen that allow you to participate or ask questions. We want you to use the Q&A button. So if you have any questions, if you think of questions, you want to join in the discussions, click on the Q&A button, join us, ask your question, and we will attempt to answer all questions during the webinar. If we have more questions than we're able to answer for the duration of this webinar, we will in fact create a transcript of the Q&A and make that available to you. Don't worry about the slides. Don't worry about the recording. We will record everything. It'll be available for you about 24 hours after the webinar. So you will have access to everything, the slides in a PowerPoint slide deck and a recording of the full webinar. So again, remember to type in your Q&A, your questions in Q&A. So with that, we're going to go ahead and get started. Steve, Denny, and Terry Lammers are principals of Innovative Business Advisors. Steve will give us an update, and he's got a fair amount to share this week. Terry will lead a discussion, and our guest today is Eric Martz, president of Martz Solutions Group. So the general topic will be planning for exit, and it's a very full-featured, comprehensive discussion around planning, including how to invest after your transaction takes place. So one of the most, Eric, I would say, is probably one of the most full function people in that space. With that said, Steve, I'm going to turn it over to you. Take it away.
Excellent, Marquita. Thank you very much, and great to have you back.
Good to be back.
Well, we've got a yeah. We got a short update this afternoon. First and foremost, it's Thursday, which means that unemployment claims came out again this morning. We were all hoping for another down step, but unfortunately, claims bumped up a little bit to 1.1 million initial claims. That means that as of this Thursday's reporting, there are still 14.8 million people that are on the unemployment rolls, and the official unemployment rate is 10.2%. The good news and the silver lining is over the last 90 days, employers have added 9.3 million jobs. And if you are an employer, now is a great time to be thinking about potentially upgrading your team. There are lots of really good people in the marketplace. We are doing that, and we strongly encourage you to do that. It's a great time to take a good look at that and see if there's an opportunity to upgrade some of the talent within your team. I want to take a minute, and I know Terry touched on this last week, going to give you a little bit of an additional elaboration. As I think probably everybody's aware that at least listens to the news on a regular basis, Congress has stalled on the fourth leg of pandemic aid. However, the administration enacted a series of executive orders. The first one that they enacted involved the deferral of payroll taxes, and that's scheduled to take place beginning September 1st, and that is for the individual employee portion. So if you're an employee, on your paycheck, you're paying 6.2% of your wages are going in as payroll taxes, and then the employer pays an additional 6.2%. The employer's portion was deferred under the CARES Act, and now under executive order, they're making the employee's portion of payroll taxes deferred for the period September 1st to December 31st. The next thing that the executive order addressed was extending the relief on rental and homeowner evictions. So if you'll recall, as part of the CARES Act, they basically put a moratorium on evictions during the lock in place and stay in place orders. And under presidential executive action, they've extended that relief. They've also extended the relief on the deferral of interest of student loans. So these are just for federally guaranteed student loans. If you have a federally guaranteed student loan, your interest on that is deferred through the end of the year as well. And then there's been a lot of play on this. They also extended the federal pandemic unemployment insurance by an additional $300 per week. And the president was able to do this until monies from the FEMA Disaster Relief Fund runs out. That it is estimated that that's going to provide an additional 6 weeks of pandemic unemployment insurance assistance. And it is also estimated that Congress will be back during that period of time, and hopefully Congress will take some action and make some things happen. As of yesterday, 11 states have been approved for this $300 a week. Those states include Missouri. And by the way, Missouri's governor is also trying to add the additional $100. So there would be the total of $400 in additional pandemic unemployment insurance. Arizona, Colorado, Idaho, Iowa, Louisiana, Maryland, Montana, New Mexico, and Oklahoma. Only one state has publicly come out and said they're going to decline to use that additional aid, and that state is South Dakota. So if you happen to be in South Dakota, your governor and legislator has decided that they're not going to extend the pandemic unemployment assistance. Just a quick reminder that as of last Friday, there's still $134 billion worth of PPP funding that's available. And under that fourth leg, there is a provision where PPP funding may continue to be extended beyond the August period. So we'll see how all that shakes out. Big change over the course of the last week is the SBA forgiveness portal is now open. So if regular attendees are aware of the fact that the forgiveness applications were available, lenders were somewhat hesitant in sharing those with their borrower clients because the SBA portal was not open. However, it did open and is now available for forgiveness applications. But if your loan amount is $150,000 or less, several of the lenders that I talk with are encouraging you to wait to file for forgiveness. And the reason for that is that in one of the potential bills that is going back and forth on Capitol Hill is a forgiveness for every borrower that received a PPP loan of $150,000 or less. So lenders are lobbying hard for that. And if the lenders get their way, that will become part of the future law. Quick reminder that if a borrower submits for loan forgiveness application within 10 months of completing the covered period, none of your payments are going to be due until the forgiveness amount is remitted back to the lender by the SBA. So even though your loan may have a deferral period on it, banks cannot require you to begin to make payments until after your forgiveness application is viewed by the SBA and that portion is remitted back to the lender. So there are people that may have taken PPP loans in early April that might be thinking that they're going to start bouncing up against the requirement to start making payments on that. And you need to be aware of these deadlines. So your loan documents may say one thing, but the law actually says something else. And then finally, just a quick reminder on the owner compensation caps and a big adjustment that we've talked about many times on our webinar, and I think there appears to be, at least right now, a final determination out by the SBA, and that is that the EIDL advance grant amounts, not the entire EIDL, but the advance grant amount, will be deducted from the approved forgiveness amount. And so if you are, let's say you had a $10,000 advance grant and your forgiveness amount was $100,000, the SBA will be remitting to your lender $90,000. So from your forgiveness amount, they're going to deduct that EIDL advance grant, and that's the amount that will come off of your Paycheck Protection Program loan. One final point, and then we'll get into some really interesting stuff. So SBA 504 program loan, their rates got adjusted this week. So what is a 504 program loan? For those that are not familiar with it, the SBA has a loan specifically for the acquisition or refinance of fixed assets, furniture, fixtures, and equipment, FF&E, machinery, real estate, construction, or remodeling within your business. These are long-term 20 or 25-year loans, and I think these are unprecedented rates. 2.214 on the 20-year, 2.269 on the 25-year fixed rate loans. Unbelievable. So if you're a business owner that could use some reconstruction, some remodeling, looking to upgrade your real estate or invest in additional equipment and machinery, now is a great time to explore an SBA 504 loan. So with that, I'll turn it over to Terry.
Thanks, Steve. Appreciate it. Hey, Eric, welcome to today's webinar. Appreciate having you on.
Thanks. Appreciate being invited.
No problem. So tell us a little about yourself personally and a little bit about your business, and we'll get into some questions I got for you.
Okay. All right. Well, I'm a baby boomer, which is important when you'll understand that when we get into the conversation about my business. But after graduating from college, I spent 4 years on active duty in the Army, and then returned to civilian life here in Indianapolis, and went to work as a retail stockbroker. I thought I was really going to help people by managing their money. I didn't clearly understand that I was a salesman. So I spent several decades in financial services in investment management as a portfolio manager in bank trust departments and in registered investment advisors. And the mission of my business is to assist boomer business owners in their accountability and their focus on the execution of all the processes that lead to the successful sale of their business.
Yeah, so we've talked quite a bit over the past couple of months, and it's interesting. We agreed that, you know, you kind of prod people along and keep them accountable for developing their exit plan and getting them to do it. And with Innovative in the CEO program, we kind of execute on things that you stir up, you know, whether it's a business valuation or coaching to help grow the company, or, you know, the brokerage aspect of it. So tell us a little bit about what's going on with the number of small business owners and the baby boomers retiring in the silver tsunami, as you call it.
Yeah, there's an estimated 370,000 business owners who turn 65 each year. And the research shows that there are nearly 80% of those folks that are expecting to access their invested capital to fund their retirement, but less than 30% actually sell the business. So there's a gigantic gap there. And so I try to focus my attention on accountability and the execution around owner readiness and the transferability of the business. Because most business owners spend most of their time in their business and very little bit of their time on their business. So owner distraction and procrastination become two real big obstacles to the sale of their company.
Yeah, it's amazing. I mean, I talk to people all the time in the mid 60s and, you know, early 70s, and they're still going 100 miles an hour and they don't have time to talk about it. But, you know, and it's sad in a way because, you know, I don't know, I think I got some comments later on in this question list, but, you know, we call a lot of that the ostrich. I think you got in some of your notes, you call winter is coming for baby boomers. Well, winter is here, right? We call it the ostrich syndrome. You know, stick your head in the sand and it'll all pass over, right? So what's your feeling about why don't most business owners start planning earlier? I mean, what's the holdup? What's the excuses you hear?
Well, I think to a large degree, business owners enjoy what they're doing and really don't want to stop. They've been spending a lot of time just trying to recover their business value from the Great Recession. And I think most of them did a very good job up until January. They're working, as I said earlier, in the business, and they're supporting, a lot of them are supporting a lifestyle business. So they're able to access the cash flow from the business, and they really may not be able to or interested in adjusting that. And you know, things have really changed with the virus hitting. Most business owners probably were pretty comfortable with their valuation as of January, but their valuation today is going to be significantly less. You know, by,
Yeah, that's
by multiple.
it's really tricky valuing companies right now. Since the middle of July, we've been slammed with valuations. It's really picked up a lot. And, you know, the tricky part of that is, did they really get hurt, you know, in the first 6 months of the year? And what's the possibility of that business coming back? I mean, if it's likely, you know, I looked at an engineering company, and they definitely slowed down the first 6 months of the year, but all those contracts are coming back, and they should be, you know, kind of back up to 2019 earnings levels by the end of the year. So, you know, this has been talked about a lot in the CVA community, Certified Valuation Analysts, is how do you handle that? Because it's never really happened before. And the general consensus is you just got to ask some questions around, is that business coming back, and will you be able to get to your 2019 levels, and really look at 2020 as more of an anomaly, so to speak. So I've heard you mention before, an exit planning begins by plotting three critical points of information. Can you expand on that a little bit?
Well, those 3 points are: where are you today, where do you need to be, and how much time do you have to get there? So, you know, what I tell people is, you know, no matter how much time you've got, you need to get started. You know, even if you get halfway through the process, you're gonna positively impact your valuation. And, you know, I think we've probably all seen the situation where a business owner gets sick, dies, something dramatic happens, and you know, the business has to be sold or transferred. So it's critically important to identify those points and get started. Put a plan together.
Yeah, and what's really sad about that sometimes, I mean, a non-financial thing that we often look at, it's hard to put a value on as far as doing evaluation, but if an owner's overly involved in the business, you know, we call that the hub and spoke. You know, he's the hub of the business, and the spoke is all the employees, customers, and suppliers that come to him. And if something happens to him, that could be a dangerous thing. So Marquita, our moderator, had an insurance company as a client, and the insurance owner passed away, and it was a complete disaster because they didn't know where any of the passwords are at and things like that. Right, Marquita? So,
yeah, it's one of the stories, Terry, that I tell when I'm talking with my clients about what not to do. And certainly Eric's giving us heads up on what to do, but it was absolutely case study in what not to do.
yeah, and what's really sad about that is it was really hard on his wife and stressful. I mean, on top of his passing, you know, trying to figure all this other stuff out was really taxing on her. I remember that. So.
I had a client a few years ago who had an investment practice, and he ended up dying from cancer in a relatively short period of time. And he left everybody that he cared about out in the cold. He left a wife and adult children, none of whom knew the business nor wanted the business. He left staff of probably 6 or 8, all of whom were over 55 and would never replace that job. He left his clients who were wondering whether they needed to be looking for a replacement manager. And at the same time, other investment managers were coming in and taking the client base. You know, it was really sad. And, you know, they eventually sold the company, but I could guarantee you that it was at a much lower multiple than it was worth when he passed away.
Yeah. So, we talk about building let's talk a little bit about building, your team of advisors that you need to help sell a business. And, this is where I think you provide a critical role in kind of introducing the business owner to who they need. And I know, especially, with Innovative, that's, one of the things that sometimes I feel like we play quarterback and we're introducing them to the right people. So, one of those people is a banker. So what role can bankers play in helping a business owner with their exit?
I think bankers can play a critical role in the accountability that the owner has for the preparation. I think the banker can have a leading role in asking the right questions. Some of the questions that I would encourage a banker to ask is, do you have a business that doesn't need you in order to be successful? You got to create a saleable business. Another question, have you systematized your business? Have you created readiness and transferability? Like, do you measure key performance indicators? So, do you have any idea where you are? If you don't know where you are, how do you get to where you need to be? And then I think questions about a retirement or a succession plan. Have you thought about that? Have you begun that? And what do you do? What happens if you're not here? What happens if you have a heart attack, or what happens if you die? Because the business still has to be transitioned. You may avoid having to do it, but your spouse, your family, your business partner is going to have to get involved, and that becomes very difficult.
I working with a client right now, talk about business partners. They're in a very tricky situation because the business partner is personally guaranteed loans to the business, and the one partner is older than the other one, so the older partner wants to exit the business, and one of the things he wants to get out of is those personal guarantees. Well, because of COVID, they've kind of loosely came up with an agreement on how that happens, but I told them, it's like, the real trick here isn't what you two agree on, is the bank going to release you from those personal guarantees. So that, that's another thing to kind of look out for also.
Yeah, I think it's critically important to have what I call a success team. The banker is a key player there. An estate attorney is important. Wealth manager, the consultant, and that would be where I fit in. And I think the value that I bring is the accountability and execution part of it. But you need a business attorney, a tax specialist, and an insurance advisor, a valuation appraiser, and then certainly you want to involve key employees, and absolutely don't leave the spouse out. But there are a lot of folks that have to weigh in so that you've got an effective success team driving the sale.
Yeah, and valuation is so important, and not to give us a cheap plug here, but I feel like the valuations that we do, we put a realistic expectation on the value of the business. And so, speaking of bankers, one of the methods that we use to valuing a business, we call the bankability method. So in other words, if I tell you that the business is worth $1 million, can you go to a bank and put down a reasonable down payment, pay yourself a fair salary, and have enough cash flow to service that debt? And I'm actually going to write a white paper for the National Association of Certified Valuation Analysts on this topic, because Steve and I have both seen several situations where this can be a disaster. But one here recently, we had an HVAC client as a customer, but before they made it to us, they paid a big name accounting firm. It was in the St. Louis area, not that that matters, but they valued his company at $1.3 million. He had 2 plumbers and 2 HVAC techs, of which the owner was one of the HVAC techs. Well, the $1.3 million wasn't even close to be a bankable deal. and they tried to sell the company to a key employee, but because it wasn't bankable, the deal never went through, and the owner was adamant that the price was right because he paid a lot of money for this valuation. Well, the key employee ends up leaving because of the dispute. So now the only HVAC tech is the owner. And now you have a non-financial thing affecting the sellability of the company because nobody would buy the company because HVAC techs right now are, I mean, they're all running 110 miles an hour. So, you know, they didn't want to buy the company if there wasn't techs to go along with it. But at the end of the day, I valued it at $500,000, and it was a very bankable deal. So, you know, what I want to talk about in my article in NACFA is the dangers of overvaluing these small businesses, especially if, you know, there has to be a bank involved in making that transfer happen. So, so you talked about attorneys. Talk about attorneys and the importance of using an attorney that has, you know, transactional M&A expenses versus, say, I've had some nightmares with people wanting to use their estate planning attorney versus somebody that's well versed in M&A transactions.
Yeah, when you're going through one of these transactions, it's critically important to have the right type of professional involved. And while, and this I think applies also to the CPAs, you know, you need people that have experience in the sale of a business. You've been happy with your existing attorney, family attorney, family CPA, but when you get down to selling your business, you know, this is typically the biggest financial transaction of your life, and you want to make sure that you do it right, that you dot all the I's and cross all the T's, and you get things done in a timely manner, because there's a big penalty if it gets screwed up. So I always advise people to, you know, do a thorough search to get the right professionals involved for the size and structure of your company.
Yeah, it's really scary when, you know, I talk about in my book that, you know, don't let the attorney take over the deal. And I personally have an experience with buying a company where the owner hired their estate planning attorney, and it was a mess. I mean, this was, you know, over $1 million deal, and we were supposed to have a meeting to hammer out the final details of buying the company. And for whatever reason, well, there was reasons, it had to be a stock sale. So we show up, the seller's got 2 attorneys. So naturally, us as the buyers has to have 2 attorneys, and the estate planning attorney sits down and says, well, you know, the beginning of this meeting is really going to depend on one thing. You know, in a stock sale, you take on all the existing debt of the seller. And our faces went blank, because that is normally true, but you can negotiate what that balance sheet is going to look like when you take over the business. And that meeting didn't end well, because it added about $240,000 to the purchase price, and we ended up walking out. We did get it worked out, but that estate planning attorney about foiled, you know, the retirement plans of the client. So it's very important. So, you know,
not only almost foiled their retirement plans, but also cost them a significant amount of money and additional time and expense in the transaction.
Yeah, and some hair behind the back of my head, because they go crazy. It was just an unbelievable moment. It's like, I can't believe that just happened. I mean, we literally had everything worked out, and to come in and say, you know, what she did, that we had assumed a debt, just didn't make sense. So, but, you know, Eric, we talked about valuations, and another thing that's disturbing to Steve and I when we're working with clients and they don't come to us until they're, you know, let's just say mid 60s, and they have this fallacy in their head about what the value of the company is. And I talk about a story in the book where it was right when I started Innovative, a guy came to me and he said, you know, I don't need to talk to a business owner, but I would like to get your you know, got a couple questions for you. So I'm like, all right. So he brought me, you know, his tax returns, him and his wife. And you know, they flop them on the desk and they're like wanting an answer like right now. So I thumbed through them real quick and, you know, asked them, you know, do you have any add backs? You know, is there any personal expenses coming out of the company that, you know, a new owner wouldn't have? And he looks at me and goes, nope, mom does the books and they're squeaky clean. And it's like, all right. So I looked at it and I'm like, you know, it's probably worth about $250,000. And he looks up at the ceiling and she looks out the window, and the next thing you know, there's a tear coming down her eye. And I'm like, oh boy, that wasn't the right answer. I was like, all right, stop. You know, what's going on? Well, the company had about $1.3 million in sales. And he said, well, I just assumed that, you know, if I had $1.3 million a year in sales, you know, this company's got to be worth $1 million. And it's just, you know, it's just not the case. It's all about cash flow. And the mom popped up about then and says, you know, we got a credit card that, you know, we pay about $5,000 a month on, and it's really just all groceries and going to the restaurant and gas for our personal vehicles. And I'm like, well, there you go. You know, that's an add back. And so that added back $60,000 of cash flow. So at the end of the day, the business is worth maybe, you know, $400,000. But the whole point is, and the importance of having an accurate valuation is to know what is the value of your company, and then to go work with a wealth advisor to know if that number works for you. Wouldn't you agree, Eric? I mean, that's another key piece of the team, right? Your wealth advisor.
Oh, absolutely. And you know, in most cases, the business owner already has somebody involved there, but you need to get them involved early on so that you get an estimate of what's going to be the net payout, so that the wealth advisor can tell you what's that going to be in terms of any income that it can generate, and that would be relatively low in this environment, you know, and you know, how much risk are you willing to accept to generate more? Are you going to dip into principal? How much time do you expect to use this? But you know, when I talk to folks, I try to get them to be very cautious in their expectations for the value of the company. Get a thumbnail sketch of what the value is, and then get somebody like you to go in there and really take a deep dive and give them a accurate valuation. But you know,
yeah,
so many folks have been taking cash flow out of the company. You know, they distort the value of the company.
I'm taking notes as we go. Yeah, you're right. So, I mean, that brings up a couple things. So one, we talked about cash flow, and you're talking about the tax situation. So that kind of leads me to my two mantras that I talk about all the time, especially when I'm doing public speaking and stuff. And one is, your company isn't about sales and net income. It's about your gross profit and cash flow of the company. So it really boils down to that cash flow. The second one is, it's not what you sell your company for, it's what you get to keep net of taxes. So, you know, and you can paint different scenarios, but where was I going with the next point? Too many things going through my mind. But, you know, so back on the valuation piece, another thing, curious with your experience is, I'm doing two valuations on similar situations right now where the owner wants to sell the business to either a sibling or a key employee. And, you know, another oftentimes sad thing that we see is they've identified the person that wants to buy the company, but they've never done nothing to set them up to be able to afford to purchase or take over the working capital of the company, which oftentimes can easily exceed $500,000. So do you see that often yourself?
I think that happens quite often, that they're late in beginning the conversation about how they want to transition the business. They haven't involved the folks who they think should own the business, and they really haven't prepared those folks to run the business. And that happens both with family members and with key staff that that they haven't done a good job in training, because you know what they're doing is they're turning their life's work and value over to folks, and if they run the business into the ground because they weren't prepared, weren't trained, you know, that impacts them as well. And when you look at the exit paths that are available, there are basically 5 exit paths. You can sell to existing management, and that makes up about 41% of owners that go that path. You can go the path of transferring to children, which is about 24% of the time. You can look at sale to a third party, and those would be tactical or I lost the word, but that's about 29% of the time that you sell to a third party. A very small percentage goes towards ESOPs, employee stock ownership plans, which are qualified retirement plans. And then the 5th is the most disappointing, and that's where the exit path, where the owner failed to do anything, failed to prepare, and he closes the doors, which happens far too often.
Yeah, and that's sad. So just a quick note, if anybody's got any questions, feel free to type them in the Q&A section and we'll answer them as we go along. While you was talking there, Eric, it reminded me of a situation when you talk about the owner wanting to sell it to key employees, but I had a situation a couple of years ago where the owner decided to sell it to a third party, but they did a really good job in that the 2 owners, husband and wife, could go on vacation for 2 weeks and the company run itself, all the things you aspire to do. But they had 2 key employees that if they didn't stay, the buyer wasn't going to buy. So we had a really awkward situation, literally within 2 weeks of closing, of how do we tell these 2 guys, you know, and does the seller make them sign some kind of an employment agreement? As it turned out, this was kind of a blue collar company that never signed an employment agreement or non-compete. So there was a big conversation again between attorneys, which naturally added more expense to it. But, you know, about, do we make them sell, or, you know, do we just say, you know, everything's going to be great, we look forward to you joining us, you know, we're going to start a profit improvement plan, or do we make them sign an employment contract and you know, a non-compete? And Marquita, if you remember, we was taking our value builder certification in Las Vegas, I believe, and I asked the room of advisors there, you know, explain the situation. It's like, what would you do? And it was literally like a 50-50 split. What we ended up doing is not making them sign a employment agreement or a personal guarantee, because they'd never done that. And what's the chance of a blue collar worker to tell you, you know, how much they don't like that, right? So, but that can be another tricky thing. So do you talk to business owners? You know, one thing that could have mitigated that situation is if they would have put golden handcuffs on those 2 key employees. Is that something you talk about to a lot of your, you know, exit planning advice?
I think it's important to have open conversation at the beginning to find out, you know, where the business owner wants to go and how well prepared he is to execute that strategy. I think key to is a coordinated effort, and that comes down to accountability and execution, which is, you know, going back to my opening comments where I think I add the most value. You know, if you can't execute, the whole of your effort will always be less than the sum of the parts. You know, so many guys are unprepared to execute, and they don't get the right people involved to do that. You know, we talked about bankers and their responsibility early on. Well, you know, the banker can really blow up his business if he gets the wrong people involved and they don't complete the transaction, because it's his reputation that's at stake if he was the key advisor. So
Yeah, you know, and that can get to be tricky too, because a lot of times, whether it's the banker or the accountant, they may be losing a client through this process. So I remember selling my company, and we had reviewed financial statements and everything else. So we spent a lot of money on accounting, and it was evident that the person I was selling the company to was not going to use them. You know, they had their own accounting and legal and everything else. And I remember my accountant wasn't pleased that I sold my business. So, but the sad thing about that is, you know, sometimes, and this is sad, but they may try and derail it a little bit. I wouldn't say that's the norm, but you know, that's, you know, a definite possibility. So, you know, the other thing I'd like to go back on a little bit with talking about getting a valuation, knowing what the value of your company is, and if you want to sell it to, whether it's a key employee or a sibling, and you never set that person up to be a bankable person, a lot of times that forces the owner into providing owner financing. And we recently worked with a family that the dad had to provide 100% owner financing to transfer the business to his son. So that's all well and fine, right? If Junior runs the business right. But the sad part is, mom and dad needed a sale of the business to fund their retirement. So now you got a real tricky situation where if, you know, the sibling doesn't run the company right or runs it in the ground, mom and dad lose their retirement.
Yeah.
So
Very real possibility.
yeah. So interesting. So talk a little bit about how, you know, you think financial advisors, bankers should really work together with each other and provide that team atmosphere.
Well, you know, it goes back to accountability and execution. You know, somebody's got to be in charge. You know, and it's important to understand who's in charge at the very beginning, and everybody's got their roles, and you know, they've got to achieve their responsibilities in a timely basis. Otherwise, the whole thing comes off the rails.
Yeah, it's tricky. So, you know, we talked a lot about family and family dynamics. Have you ever heard a book by Tom Dean, Every Family's Business?
No.
So it's a very interesting book, and he puts a list of 21 questions at the end of the book that he recommends every family business ask themselves on an annual basis. So I'll include those questions along with the recording of the webinar when we send that out on Monday. But basically, the book is about two gentlemen that meet on a plane. They both just sold their business. One asked these questions, and everybody, the whole family was aboard with where this thing was going. And the other guy never told anybody, and he just automatically sold it to a sibling that didn't even really want it. And it was, you know, at the end of the day, it was a train wreck, and you had some very unhappy clients and things like that. It reminds me of another company that I valued where the daughter was really the most qualified person to run it, but the dad wanted to sell it to the two sons, and they really didn't want to have anything to do with it. So you ever come across any odd situations like that in working with some of your clients?
Not like you described, no.
Hey, Eric, let me ask you a question, if I may, Eric.
Sure.
You've been doing this a long time, and I know I'm sure you've had really strong success stories, and you know, probably some train wrecks that you don't care to discuss. But what's your recommendation if you had the ability to wave your magic wand and you know could talk to a business owner ahead of time? How much time would you tell them to put in investing in a transition plan? How far in advance? And do you have some specific steps that you would recommend? If you wouldn't mind sharing with us for a few minutes what you think a best case scenario looks like?
Yeah, I think a best case scenario is first of all driven by the right questions, and that one of the early questions is, you know, obviously, where are you now? Next question is where you want to go and how much time. But you need to start 2 to 3 years ahead of time really, because it's not like selling your house. You don't just stick a sign in the yard and hope that you get an offer in the next 3 weeks. You know, you need to know what you're trying to get, and you need to prepare the business, because you really need it to be fully valued when you get to the sale table. And what you need to consider is when that potential buyer looks at the numbers, they can figure that, number one, they can turn a profit from day one, and number two, they don't need you. And so often business owners haven't figured that out. They want to value the business for what they think it's worth, and it's unfortunate, but the business will not bring that, and so the buyers turn their nose up and walk away. So it's important to begin with questions, all kinds of financial questions, business questions, personal questions. I would say that 2 to 3 years, having a key player, somebody that's going to be helping with the accountability and execution of the strategy, and then start picking your specialists to add value. You know, the dynamics of what we're facing with so many more sellers, the baby boom business sellers, outnumbering the potential buyers by 30 to 50,000 individuals a year. You know, it makes you think about the old story about the hiker and the bear, you know, where you don't have to outrun the bear, you have to outrun the other hiker. That's the way it's going to be with the sale of baby boom businesses. There aren't going to be enough people to buy them. So it's to your advantage as a seller to be prepared, be able to prove your story, you know, track all your financials, be able to show that the company is worth what it is, and come to the market well ahead of when you absolutely need to be out.
So Eric, this is Marquita. I have a question for you too, and that is, when you think about the portfolio of clients you have, or the target client who best works with you, could you speak to or say something about what works? I know you've said baby boomers, but beyond the target of baby boomers, when you think of the ideal scenario where your advisory expertise can help, what does that client look like that is really your best client?
Well, I'd say it's somebody that's within 5 years of when they want to retire. I don't think it makes any difference what industry they're in. Yeah, I don't have, my background and experience is all in financial services and the military. So, you know, when I've talked to people that have a manufacturing firm, you know, they kind of turn their nose up. They don't think that I'm the right guy to help them. But, you know, it's about big picture thinking. I don't have the expertise, but I'm a key player in bringing in the expertise. What I'm doing is helping to formulate that team and to create, overusing it, but creating the accountability and the execution, which you know, are the biggest things. Ron Sharon wrote a book about execution a few years ago, and in there he said an organization can have talented people and superb strategy and still fail. You know, it's rarely because of the lack of smarts. It's because of bad execution, and that's not just about exit and succession planning. That's about running any kind of a business from day to day. So
yeah,
I may have missed answering the question, but
it's interesting. And I think there's, you know, a couple of things. There's going to be some prime opportunities for acquisitions here and companies to grow by acquisition. So, and that's how I grew my company back in the day, was, you know, buying other companies. So if you're, you know, a business owner or you have business owner clients, that's certainly a seed to plant in the mind. And then, I think another thing that's important to bring up is, as a valuation analyst, I'm typically valuing the current cash flow of the company. And there's very strategic reasons to buy other companies because you're eliminating a lot of the operating expenses that they may have. So, when I give you a valuation, typically I'm giving you a financial value. You're valuing the current cash flow. But if you're buying another company as an add-on to your current company, think of the strategic value of that company also. So, and that makes sense too, wouldn't you agree?
Yeah. Yeah, and it made me think of your story in your book when you were talking about the buying the business that was closer to the end users. So
yeah,
exactly.
That's a good story. It was a company that was right in the middle of where I had 2 bulk plant storage facilities, and in my opinion, he wanted $100,000 too much for the company from a financial perspective. But it was an area of high customer concentration, and the last thing I wanted was somebody to buy him out and have a bulk storage plant right in the middle of an area where I have high customer concentration. So in the book I say, did I pay him the extra $100,000? Heck yes, but it was a very strategic purchase in that, I didn't acquire but maybe 20% of his operating expenses. So, from a strategic perspective, it was still a very good acquisition.
And when you think about the excess of baby boom businesses that'll be on the market, most of them won't be prepared to demand full value. So, if you've got somebody that's interested in buying and growing through acquisition, there are going to be a lot of opportunities in the next few years.
That may be the most important point of the day, Eric. I think we agree 100% with your viewpoint on that. And if I heard you correctly, basically what you see coming is the table is going to be very heavily slanted towards buyers. There are going to be so few buyers for the tsunami of sellers out there that the buyers are going to be able to set the terms. And if you're in a business that has got competitors and they're going to come to market at the same time you are, and you're not able to distinguish yourself effectively against your competition, it's going to be a race to the bottom in terms of price. Would you agree?
I do. I think you're right on target, Steve.
Yeah.
I think.
Steve?
I also want to, I had a very sobering breakfast this morning. I had breakfast with a bank president. And Eric, you and I both lived through, 07, 08, 09 in this industry. And I remember at least very painfully, you probably do as well, what that period was like. And this bank president this morning shared with me that he believes that we are going to see a very similar occurrence in the fourth quarter, because the bottom line is the banks are all now working as hard as they can to evaluate and try and value their capital structures. And he believes that there are going to be an awful lot of lending institutions that are going to be making free agents out of their customers in the near future. And all of a sudden business owners are going to have, notes called because the banks won't have any choice. They've got to readjust their risk portfolio for the times. And he was telling me that he said the biggest thing we can do for the community is begin to talk to business owners and make sure that business owners put themselves in the best condition maybe of their business life right now, because he feels very strongly that's coming.
I would agree. Yeah.
And that's been ringing in my ears all morning.
Yeah. Causes your stomach to turn.
Yeah.
Very interesting input back from your banker, because as we sit here and looking at the clients that we work, me specifically from a more of a consulting coaching perspective, and Steve, you and Terry more from a deal perspective, the transaction perspective, something has to give at this point. And what we saw was this very interesting business drop for some businesses. Some actually prospered, but for many businesses, there's been this drop. And we managed to get to August because of the CARES Act, because of what we've been talking about over the last 3 to 4 months. And I think we're at a point where the appetite at the federal level perhaps is not such that it will take us much beyond the next couple months. And you're right, fourth quarter is where that train, and you talk about the train hitting the crossways, is I think that's about the time frame. Now that's Marquita talking, and I'd be very interested to hear your thoughts on that too, because the bottom line is, as a business owner, you have to be ready with a fallback position for debt if you're carrying a heavy debt load, because that is what's going to be the takeout at this point. No matter what you've built back up, and no matter how well you're building your revenue stream, if you're sitting on heavy debt, it could take you out before you get to the point of realizing that new revenue stream.
Yeah, another interesting thing to add on to that is, I've bought a lot of companies in a lot of different ways, and earnouts and things like that are not always an exception to the rule. So you can get very creative on how you're buying a business, and in situations like that, there's a lot of times the banks are willing to take a pretty good haircut just to get that thing off their books.
Mm-hmm.
So,
and Eric, what you shared with us is obviously we all know to be gospel. The vast majority of transactions happen with insider purchases, right? In light of all that, how do you recommend business owners proceed? If they're thinking about an insider purchase, right? Do you have specific recommendations that you work through in those situations?
I would recommend them to sit down and talk to somebody, me for example, just about how they're structured, staff-wise, process, procedures, protocols, make sure that things are operating efficiently. I've worked with a couple of firms. They were financial investment type firms, and we could have improved things a great deal if they'd restructured their internal staff and operations, but they weren't paying attention to the key performance indicators. They were just operating kind of off the cuff, and I think it's just critical to have a discipline about what you're doing.
Yeah.
Well,
Hey, we're getting to the top of the hour.
exactly.
So, Marquita, I'll let you kind of wrap it up, and then I guess real quickly, our guest next week is going to be Brian Rogers from the Blue Haven Law Firm. So we're going to talk about a lot of legal stuff, which is also very interesting. So go ahead, Marquita.
Okay. Great, Terry. So yeah, let's go ahead and wrap up. I tell you, I was enjoying the conversation so much, I'll let time get away from me. And we're right up at the top of the hour, but I'm still going to do the wrap up the way we normally do. And I will give each one of you an opportunity to make some ending comments. I'm not going to go through the full spiel on where you can get the information, because there's an email coming. Just trust that in the next 24 hours, you'll have an email and you'll have access to everything we discussed, including a full video recording. But with that said, I'm going to give each one of you an opportunity, and I'm going to take you in order. Terry, you first, then Steve, then Eric. You're going to get the absolute last word. So Terry, any last comments from you?
Yeah, so we talked about KPIs and watching the statistics of your company, and to give our chief everything officer to chief executive officer, CEO to CEO program a cheap dig. That's exactly what we do. We teach you your financial statements, teach you some really key performance indicators, teach you what your bankability is, and non-financial things to help you buy or sell a business, or buy or sell your business. So check out our CEO to CEO program online.
Thanks, Terry. Steve, last words from you.
Eric, I just want to say thank you very much. We really appreciate your participation today, and I think that point is a central point, and I appreciate you making sure to bring that out to us. So we wish you all the best, and let's get out and help as many of these business owners as we can.
I appreciate that.
Thanks, Steve. Okay, Eric, you get the very last word in the webinar. What do you want to share?
That's great. I appreciate that. I'm an individual that loves quotation, so I'll end with a quotation. Abraham Lincoln said, you can escape responsibility of tomorrow, but you can't evade it. And you know, that's exactly what we're faced with the baby boom generation. And you know, the Army taught me that execution is a discipline, and I believe that that's totally appropriate now. So I encourage everybody to figure out where you are, where you need to go, and how much time you need to get there. Thanks for having me on. Thanks
so much, Eric. And to all of our participants, thanks for joining us. We'll see you again next Thursday, same time. Bye-bye.